Hey everyone, welcome back for another deep dive. Today we're going to be talking about building wealth.
Specifically through dividend reinvestment plans.
Yeah, DRIPs as they're often called.
That's right.
And we're going to be looking at it with a slightly different lens than maybe you've seen before.
And what's particularly interesting about this is we're going to be talking about dividend champions.
Dividend champions, okay.
Yeah, and we're going to be looking at this through the lens of high dividend yield.
Okay, so before we get into the strategy itself, can you just walk us through like what is a dividend champion and then also what is dividend yield?
Sure. So a dividend champion is a company that has consistently raised its dividends for at least 25 years.
25 years, okay.
A quarter of a century.
So that's like pretty impressive, right? Like to be able to do that consistently.
Well, it speaks volumes about the company's ability to navigate different market conditions, economic downturns, and still deliver value to shareholders.
Yeah, so it's not just riding like a wave of good fortune. It's like they're actually able to consistently deliver regardless of what the market's doing.
Yeah, consistently increase your dividends over time.
Okay, so that's a dividend champion. And then what about dividend yield? What is that?
So dividend yield is the annual dividend payment per share divided by the stock price.
Okay.
So, for example, if a company pays an annual dividend of $2 per share and its stock price is $50, the dividend yield would be 4%.
Okay, so it's like a measure of how much income you're getting back on your investment.
Exactly.
Okay, and you said high dividend yield, so what would you consider high?
In this context, we'll be looking at dividend champions with yields of 7% or higher.
7% or higher. Okay, that's a lot higher than you typically see from like savings accounts or even bonds.
Right, and that's the allure of dividend champions. They offer the potential for substantial income over time.
Especially when those dividends are reinvested.
Exactly. That's when the real magic happens.
So that's where the reinvestment part of DRPs comes in.
The power of compounding.
Compounding. Can you break that down a little bit for me?
Sure. Imagine you invest $10,000 in a dividend champion with a 7% yield.
Okay.
Each quarter, the company pays you a dividend, which you immediately reinvest to buy more shares.
Okay.
Now, let's say the stock price doesn't change, just to keep things simple.
All right.
With each dividend payment, you're buying more shares, which in turn generates more dividends.
Okay, so it's like a snowball effect.
Exactly. It's compounding.
So even if the stock price stays the same, my investment is growing because I'm getting more and more shares.
That's right. And the longer you let it run, the more dramatic the results.
Interesting.
In fact, after about 11 years, you would have doubled your initial number of shares just from those reinvested dividends.
Wow. So even if the stock price didn't move at all, my investment would have doubled in just over a decade.
That's the power of compounding.
It's not about quick wins. It's about consistent growth over time.
Exactly. And it gets even better. Just 3 years later, you've tripled your shares.
So 14 years later, you've tripled your shares simply from reinvesting the dividends. Precisely.
Okay, I'm starting to see how this can really add up over time.
And that's just the beginning.
Okay, but I have to ask, how do we even find these dividend champions?
Well, there are resources available online that track these companies.
Okay.
One example is dripinvesting.org. They have lists of companies with long histories of dividend growth.
Okay, so it's not like some secret society.
Not at all. It's about doing your research and finding companies that align with your investment goals.
All right, so we've talked about dividend champions, we've talked about dividend yield, we've talked about the power of compounding. So what's this unique twist that we're going to be exploring today?
That's where things get really interesting. We're going to be looking at how to combine this DRIP strategy with life insurance.
Okay, life insurance. I wouldn't have thought of that.
Most people don't, but it can be a powerful tool when used strategically.
All right, well, I'm intrigued. Let's dive into that. All right, so you mentioned life insurance. How does that tie into this whole DRP strategy? Well, it's not as straightforward as just buying a policy, but when used strategically, life insurance can actually amplify the benefits of DRPs.
Okay, I'm listening.
Let's imagine a couple, John and Sandra. They're looking to build a solid income for retirement and beyond.
Okay.
John's 36 when he decides to start a dividend-paying whole life insurance policy.
A dividend-paying life insurance policy. I've never heard of that before.
It's not as common as term life, but certain whole life policies offer dividends based on the insurance company's profits.
Huh. So these dividends, they get reinvested to grow the policy's cash value.
Exactly. It's like a built-in mini DRP within the life insurance policy itself.
Okay, I'm starting to see where this is going.
Now, here's the twist. At age 40, John takes out a $10,000 policy loan from his life insurance.
Wait, He borrows from his life insurance to invest? Is that even allowed?
Absolutely. Many whole life policies allow you to borrow against the cash value.
Oh, okay.
And the cool part is the remaining cash value in the policy keeps growing, even with a loan.
So it's like he's got two engines working for him.
Precisely. One is the life insurance policy with its compounding cash value, and the other is the DRIP portfolio fueled by those dividend reinvestments.
This is making my head spin a little, but I like it.
It's a powerful combination.
So what happens to the loan? Does he have to pay it back right away?
Not necessarily. He can repay at any time, but it's not mandatory. It can even be deducted from the death benefit.
Interesting. So there's flexibility.
Exactly. It's about having options.
So let's talk numbers. How did John and Sandra's plan actually play out?
Well, after 20 years of reinvest in dividends, their $10,000 DRP portfolio grew to almost $95,000, even with a flat stock price.
Wow, that's a pretty significant return.
And keep in mind, this is on top of the growth in his life insurance policy's cash value.
Right, so it's like a double whammy.
You could say that.
So they essentially turned $10,000 into almost $100,000 in 20 years.
And that's a conservative estimate.
So how do they actually use this money in retirement?
Their plan was to use the dividend income from their DRP portfolio to fund their travel.
Living the dream.
Exactly, and that income stream would continue as long as they held those dividend-paying stocks.
That's incredible.
But that's not all. Remember, John's life insurance policy was growing steadily this whole time.
Right.
By retirement age, his policy's cash value had ballooned to over $743,000.
Over $700,000 in cash value. That's a serious chunk of change.
It is, and they had options.
Like what?
They could surrender the policy and take the cash.
But then they'd lose the death benefit, right?
Correct. Or they could hold on to it and let it keep growing.
Or
they could leverage that cash value to supplement their retirement income.
How would they do that?
Similar to how John took out the policy loan earlier, remember. He could take out another loan or establish a line of credit against the cash value to access tax-free income.
Tax-free. That's a pretty sweet deal.
It is. It gives them even more financial flexibility during retirement.
So the life insurance policy isn't just sitting there. It's like a dynamic tool.
Exactly. It's about creating a multifaceted approach to meet their financial needs.
I'm seeing the bigger picture here. It's not just about investing in stocks. It's about building a whole financial ecosystem.
That's a great way to put it.
And life insurance plays a key role in that ecosystem.
Absolutely. It's about protection and growth.
Okay, but how did John and Sandra actually manage their money during retirement? Did they rely only on the DRIP and the life insurance?
Actually, their situation is a bit more nuanced. It's a great example of diversification.
Okay, tell me more.
In addition to the DRIP income and the potential to tap into their life insurance, they also had other income sources like Social Security, and John had a pension.
So they weren't putting all their eggs in one basket.
Not at all. They built a network of income streams to ensure a comfortable retirement.
Smart moving.
And that's what we'll explore in the final part of our deep dive. We'll look at the specifics of their retirement income, how they managed the life insurance policy, and ultimately what happened to their DRIP portfolio.
Okay, I'm hooked. Let's wrap this up. Okay, so we've seen how John and Sandra set themselves up for retirement with their DRPs and life insurance. But did it actually work out for them?
Oh, absolutely. They were living the good life.
Like, really?
Yeah, remember they had that DRP portfolio pumping out income? And John's life insurance policy was worth a fortune.
Right, over $700,000.
Exactly. They had a rock-solid financial foundation.
But, like, how much were they spending each year? Could they afford to travel and enjoy themselves?
So their goal was to travel and have fun in retirement, right? They didn't want to just sit around and pinch pennies.
So did they pull it off?
It sure did. Between John's pension, Social Security, and Sandra's part-time job, they had about $50,000 a year after taxes coming in.
Okay, not bad, but was that enough to fund all that travel?
Well, here's the thing. They had that line of credit against John's life insurance, remember?
Oh, right.
That gave them an extra $36,500 per year tax-free.
Wait, tax-free?
Yep. So they basically had over $86,000 a year to play with without touching their investments.
That's amazing. So they could travel and live comfortably without worrying about money.
Exactly. They had the best of both worlds.
So over their whole retirement, how much did they actually spend?
Get this, over 26 years, they spent a whopping $2.25 million.
$2.25 million. That's insane.
That's the power of planning and making smart financial choices.
And all that time, their DRIP portfolio was still ticking away in the background, right?
Oh, yeah. Even with a flat dividend rate, they were still getting over $14,000 a year in passive income.
So they had a comfortable income and their investments were still growing. It's like a win-win.
Precisely. And that initial $10,000, they invested in the DRP.
Yeah.
Well, by the time John passed away at 91, it was worth almost $95,000.
Wow, just goes to show you the power of long-term compounding.
And after John passed away, the portfolio went to Sandra, so she was taken care of.
So their plan didn't just benefit them, it benefited their family too.
Exactly. They built a legacy of financial security.
It's really inspiring to see how they took control of their future.
It all starts with taking that first step and educating yourself.
Well, I think we've learned a lot today about dividend champions, compound and life insurance, and the importance of planning for the long haul.
It's been a pleasure sharing these insights.
Remember, folks, it's never too late to start building your own financial future.
Absolutely. Start investing in your future today.
And on that note, thanks for joining us for another deep dive.
Until next time, happy investing.